Does take us to our talk of the tape. With another month about to be in the books, what does lie ahead for your money over the remainder of this year? Let's ask Cameron Dawson, Chief Investment Officer for NewEdge Wealth, with me here at Post 9 once again. It's good to see you.
Good to see you.
How does the backdrop feel to you in this market?
It's not too surprising to see this volatility. We had been seeing this somewhat dangerous divergence start to brew over the last month, where yields moved a lot higher. Earnings estimates were getting cut for the fourth quarter and for 2025. All the while, the market kept pressing to new highs, and it was based just on valuation. So now that you're calling more questions about earnings with what Microsoft and what Meta said and that outlook into 25, not surprising to see some of this volatility kind of catch up to us.
Yeah. Speaking of, did these mega cap reports, is the lesson today that they need to be really perfect?
I think so. I think given the fact that positioning is so crowded, we can talk about valuations. Not all of them are very expensive, but we do know that a lot is riding on these earnings, because if you look at the source of earnings growth in the third quarter, mega cap was delivering all of the earnings growth. The Mag 7, 18% growth. The rest of the 493, 0.1%, which just means that they have to keep delivering. If you look at the street estimates, that kind of high teens growth is what's expected next quarter and through the remainder of 2025.
What do you think on this final trading day of October has been the story of this month? Is it the backup in yields? Is that what the biggest takeaway is going to be, and what we need to watch closer than anything else?
I think that it is the backup in yields, because it's telling you that the increase in yields is not because of something necessarily that the Fed is doing today, but because the economy is holding up better than expected. It is raising the questions of potentially higher inflation into 2025. We don't see evidence of that yet. Look at the ECI, the Employment Cost Index today. We're not seeing a reacceleration in wage growth. But I think people are starting to call into question, are we going to get the cuts from the Fed if this economy isn't falling off a cliff?
Well, I mean, what if we're not going to get as many as we thought? How much does that matter? We got 2 more meetings before we turn the calendar into 25. What if we don't get 2? Does that matter?
It hasn't mattered all this year. We started this year with 6.5 cuts priced in, and we got all the way up to just 1 cut priced in, and the market still continued to rally. I think the kicker for the market when it comes to the Fed is the perception that if Fed rates are going to weigh on growth. That's what happened in 2022. The Fed said we're increasing interest rates. People started cutting their growth forecasts, and that's how we had a bear market. So if this market is still in an environment that says we can tolerate higher rates, it means that the Fed may not cut as much. Certain pockets of the market might struggle, like small caps, but overall, as long as the earnings story is intact, it can tolerate these higher rates.
There's been some commentary over the last few weeks that with valuations where they are, you should expect muted returns in the years ahead. You don't sound that optimistic from the notes that I've seen that you gave to our producers. For 2025, right? Your base case is for lower returns. Now, are you talking about much lower? Because we've had an amazing couple years here. So do we need 20% return to be happy? I don't know, but what are you really talking about?
We're talking about something that looks much closer to average at best, something that looks like sideways and choppy. And the reason I'd say at best is because if we take current consensus for EPS growth of about 13% and say we don't know if we can really push valuations near 22 times that much higher, which just means that at best, you get what you have with earnings growth. And at worst, you actually get multiple compression. And so it's a question of, as we move through the year, where does that valuation multiple go? And we have to simply appreciate at today's levels, there's probably a lot less upside than we had starting 23 and 24.